So corporate restructuring is topic number 5. It's called corporate restructuring and reorganization, or corporate reorganization and restructuring. Now, in some cases, in some situations, it's just a page. Take whatever I've given you first. Just take whatever I've given you first, post it on WhatsApp kindly, and then we proceed. So, right? Thank you so much. Now, I'm saying that in some cases where business have problems, they always relook at their business, all right? Wakati biashara, unafanya biashara na unaona you cannot make profits, then you have to make some tough decisions. Now, we are saying that organizations have structures, but the structure can be changed. So when you're changing the structure, then we are calling it restructuring. It could be the structure of capital. It could be the structure of departments. That is restructuring. And then we have the organization. You are organizing yourself. Just like at home, the house can be in a mess. So you are trying to organize it. We are saying you are reorganizing. And that will actually include even merging or separating part of the organization. So restructuring and reorganization are quite close. They are basically the same things. I want you to write and say that corporate restructuring is the process. Corporate restructuring is the process which accompany ownership. Corporate restructuring is the process through which, this is a process through which a company's ownership, a process through which a company's ownership, legal or operational structure of a firm is changed. It is the process through which a company's ownership, it is a process through which a company's ownership, legal or operational structure of a firm is changed in order to enhance its efficiency, stroke profitability, efficiency, stroke profitability. That one you put in bracket and say internal, put it in bracket and say internal arrangement. So when you are restructuring, you are changing the way the business is being done. Either you are changing the legal structure, operational structure, something like that. Then we are saying that you're changing the structures of the business. So the main aim is to make it more efficient. At some point, I'm sure you have received a message from the bank telling you that our systems are being worked on, or our systems are being restored, or there is a problem. They are doing something in the system. They are doing restructuring, right? Or maybe you have noticed that some bank statements can appear differently. The way they used to appear, the structure now differs, or account application form changes. That is now what we call a restructuring. You are changing the way they are. Now, during COVID-19, most companies left people. They left employees to go home. They did what we call deployment, or deployment. Is it deployment, right? When people are being put off their work, wanaenda nyumbani. So they were reevaluating their business structure, and they realized that they cannot sustain the current business with the current employee base. If you are making losses and you have so many staffs, then it is not beneficial to continue the operation that way. You need to make those tough decisions. So you will find that some departments have been combined. Maybe if you are having a department like risk and compliance, you have risk, you have compliance, you have internal audit, you might realize that these guys are doing the same thing. Risk and compliance are the same. If you comply, then there is no risk. So those who are evaluating or assessing the risk can actually do compliance job. So if you are having different departments like that, you can decide to combine them into one. And of course, whoever is doing that can also be an internal auditor. The main role of internal auditor is to assess the internal control systems and assess the possibility of risk, right? And also check when the company, whether the company is complying with the regulations, right? They lay down procedures and regulations. So it means that these departments are basically the same. Now, if you realize that you have so many employees, you can actually combine them and then you lay off some employees. So that is why we call it internal arrangement. You want to be more efficient. If somebody is efficient, that is somebody who is able to perform with little wastages. You are efficient because you are doing well. You are performing well with little wastages. I want you to proceed and define reorganization. And you say that reorganization is taking control. Reorganization is taking control of a bankrupt or financially unstable firm. Reorganization refers to taking control of a bankrupt. This is about taking control of a bankrupt, taking control of a bankrupt or a financially unstable firm by a receiver manager. By a receiver manager, taking control of the company that is in financial problems or financial distress by a receiver manager. So that is what we are referring to reorganizing or reorganization. Now, for you to reorganize, that means that you're in financial distress. I say that reorganization is about taking control, is about taking control of a bankrupt or a financially unstable firm by a receiver manager. I want us now to look at financial distress. So reorganization is changing the way you're doing business. I said earlier that you can be splitting the company, you can be merging the company. So that is reorganization, right? Restructuring is mostly internal. Reorganization mostly involves external. So now let's look at the financial distress. We are saying that you do reorganization when the company is in financial problems or bankruptcy, financial distress. So let's look at financial distress. Financial distress. This is where the company is having challenges. Somebody is making noise. Sorry for that. Sorry for that. This is where a company is having challenges. This is where a company is facing challenges. It is where a company is having challenges in meeting its financial obligation when due. Financial distress is a situation where the company is facing challenges, in meeting its financial obligation when due. Then that is distress. Distress ni mtu mwenye ako kwa shida, umefinywa zaidi. So if you don't have money, you are not able to pay your bills, we are saying that you are on a financial distress. You are on a financial distress. That is what we are talking about. I want to proceed and say that it also refers to the events. It also refers to events. It also refers to events. It also refers to events preceding events preceding it also refers to events preceding and including bankruptcy events preceding and including bankruptcy, such as inability to meet financial obligation, I'm saying that it also refers to events preceding, it also refers to events preceding and including bankruptcy, such as inability to meet financial obligation, comma, violation of loan contracts. Financial obligation, comma, violation of loan contracts. So let's look at the forms of financial distress. Forms of financial distress. Forms of financial distress. The first one is called technical insolvency. Technical insolvency. That is called short-term liability problems, also known as short-term liability problem. That is technical insolvency, short-term liability problems. Number two, insolvency in bankruptcy. Insolvency in bankruptcy. Insolvency in bankruptcy. This is where liability exceeds assets. Where liability exceeds assets. Where liability exceeds assets, we have legal bankruptcy. Legal bankruptcy. This is where court orders a firm to be bankrupt. Court orders a firm to be bankrupt following request from owners. Following request from owners. Following request from owners. It is where a court orders a firm to be closed because there was a request from owners. Unajua saa zingine unaweza shindwa kulipa pesa. You don't have money and people are pushing you. You owe them millions of money and you cannot pay. So what do? You take yourself to court and tell court, can you declare me bankrupt so that I cannot be told to pay anything? Huh? You just take yourself to court and declare yourself bankrupt, and they have to confirm whether you're bankrupt. There are advantages when you are bankrupt and you are declared by court. You cannot get into any contract. Nobody can come and claim any money from you or anything. You cannot own any asset, and you should not have money beyond some limits in your bank account. I think beyond 300 or 500 shillings in your bank account. Where uko hapo, you are poor. na hakuna mwenye anakudai pesa, hata kama unamgo mpaka ile siku the court will declare that you're not bankrupt anymore. So some people can go to court and request to be bankrupt, to be declared bankrupt. We have economic failure. So Topista, will you want to be declared bankrupt? Ndio wasikudai pesa, deni. Economic failure. This is where you say that this is where a firm's revenue is insufficient to cover its cost. Where a firm's revenue is insufficient to cover its cost. The firm's revenue is insufficient to cover its cost. The firm's revenue is insufficient to cover its cost. Now, what are some of the indicators that a company is in financial distress? How do you know? These are financial distress. These are forms of financial distress. So what are some of the indicators that a company is in financial distress? Indicators that a company is in financial distress. Number one, if you want to know that company is in problem, high labor turnover. Ukiona watu wengi wanatoroka, high labor turnover. So if employees who are in the company are leaving the company, that can be a bad indicator because they know what is happening inside the company. The next one is called inability to pay debts when they fall due. Inability to pay debts when they fall due. That can also be an indicator. A reduction in profit. Reduction in company profits. Reduction in company profits. Reduction in company profits. Inability to obtain further financing. Inability to obtain further financing. Inability to obtain further financing. Sharp increase in the cost of capital. 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 Poor financial reporting system. poor financial reporting system. These are some of the indicators that the company has got a problem. They can also be some of the ways of predicting corporate failure. Okay, so let's look at ways of predicting corporate failures. Ways of predicting corporate failures. Ukitaka kujua kampuni imeshindwa cooperate vizuri, si ati yako na shida ya pesa peke yake. Like the first one we talk about financial distress, that was basically money. Yes, they can also, nimesema, they can also be used. So ndio maana nimesema, when you want to know that the company has problems in terms of management, it has failed in something as a company, you can look at the indicators of financial distress. On top of them, you can also look at the following. They are basically the same, but I want you to look at it this way. The ones that I've given you are more of financial issues. It may fail, but those are indicators that relate to finance. Now, we are also looking at other indicators that might not relate to finance necessarily. Like when you talk about high turnover, people are seeing the company cannot pay them. Iko na shida ya pesa. That is why they are going. That is why we call it financial distress, shida ya pesa. Lakini company can just fail because of more problems than. Number one, the same things basically can be applied here. I talked about high employee turnover. Employee can go because they are not being paid well. That is in the first case. Employees can also go because the management is not doing the right thing. Sio pesa peke yake, but they are also mismanaging the company. Number two, high overdraft facility. High overdraft facility. In financing expansion. In financing expansion. The other one is poor credit rating. Poor credit rating. Poor credit rating. Continuous decrease in profit margin. Continuous decrease in profit margin. Continuous decrease in profit margin. Over-reliance in borrowing funds, which increases the gearing ratio. wanachukua deni sana, so that hiyo deni ina increase the risk. Now, our reliance on borrowed funds, which increases gearing risk. We agree that when you borrow too much, you get involved in risk. Now let's look at reasons for corporate reorganization. Why would a company reorganize itself? Reasons for corporate reorganization. Reasons for corporate reorganization. Number one, to focus on cooperation. You know, sometimes you can find yourself doing everything. You can find yourself doing everything. We have some colleges that are offering almost everything. Wanakuambia wanaofa sifa, wanaofa wanaofa sisa, wanaofa CS, wanaofa ICT, wanaofa CPA, wanaofa HR, they have marketing. Then unaangalia hii kampuni tunapata klasi ya marketing iko na mwanafunzi moja, and they have to teach that student the whole semester. It is not even making sense. You look at it, you say that we need to restructure ourselves. We need to reorganize ourselves. So what are we going to do? We're going to shed away or shed out some units that are not profitable. Like here, we can decide to stop teaching some units if we have realized that they are not profitable. Next semester, we don't offer them, right? So that is called reorganization, so that we can focus on areas, on our core areas. You say that with us, we are only doing CPA. We don't do CS, we don't do CFA, we don't do whatever, CFFE, we don't do those ones. So that we focus on one that is making sense. Instead of having two students who are CFFE, which requires around 6 teachers to be taught, and at the same time, those units are not marketable, or they are not giving value. The next one, so are we together? That is focusing on core operation. Generate cash flow to pay off debts. So what are we trying to do? When we focus on the core businesses and leave out the ones that are expensive unnecessarily, we shall be able now to get more cash flows that can be used to pay debts that we are having. Number two, during reorganization, we can do away with part of the organizations that are not making profit. If it is a building, if it is a machine, we simply sell it and get revenue to pay off debts. That is called reorganization. We can be able to generate more income to pay debts. We have mergers and acquisitions. We can also merge because our main aim, we can also reorganize ourselves because we have been merged. Mergers and acquisition. You can reorganize yourself because now you are being merged together with another one. That is mergers and acquisition. Okay. The next one is management style. I don't know whether you guys have seen, when a new principal comes in school, they normally try to change things, or when you have a new CEO, akiingia unaona ana change vitu. So he's reorganizing the department. Unaambiwa, oh, new operation manager has come in. They start changing things. Sometimes they just do the change for the sake so that people can see that a new person has come in. Yaani wanafanya tu hizo vitu ndio ionekane kwamba things are not remaining the same. Right? Or they are taking advantage to remove some people away. So a new management style, you can reorganize yourself because there is a change in management style. So you can call it management style or change in management style. What has changed in NTC? Is there anything that has changed in NTC? What has changed? Another one is downsizing. You can be reorganizing so that you can downsize. You reduce a lot of things. A business adopt new strategy or alter their new products mix. Some staffs are made redundant. In such situations, organization may need to downsize their workforce through restructuring. So downsizing is also one of them. You can also change because of technology. There is a new technology, and you have to adapt this new technology. So new technology, and maybe technology is a good thing, but is it really a good thing? Have you gone to banks? You'll find that in banks, like you go to ACB or cooperative bank, kama wako na floors kama mbili, the first floor hakuna watu, unaona cubicles just empty. Unapanda juu unapata watu wako huko. Downsizing is about reducing the number of staff. Sasa they were so expensive. Ulikuwa na 77 staff duplicating the same job, wengine wako tu TikTok, wengine wanapiga story, wengine wako WhatsApp, nothing they are doing. So unasema hapa wengine waende nyumbani. Sasa downsizing. Thank you. Now, new technology you can also structure new technology. Ni ukweli sasa hivi watoto wako TikTok. Even my staff saa zingine napita hivi napata ako TikTok na hajafanya account. Hajamaliza kudraft account lakini ako TikTok. Anakuambia alikuwa na watch kitu tu kidogo. At the end of the day, account has not been drafted. So you can tell them, now I want to do this job. Make sure that you draft account and also do this other job. They are quite busy. So that they don't have a lot of time loitering around, wasting time, man hours, right? New technology, you can also change because there is a change in new technology. And I was explaining that when you go to bank like KCB or Co, you'll find that, I'm giving example because they are big banks and they have big branches. They have so many staffs. With the new technology where now we have machines that you are able to do RTGS, you can be able to do EFTs. We also have online banking. We have iBank, right? That is internet banking. We have M-Pesa. So what are they doing? They are trying to send people away. That is why when you go to open the bank account, the first thing they ask you, do you have M-Pesa? Yeah? They want you to register M-Pesa so that you can be able now to deactivate your mobile banking. So they ask you come out on a mobile banking so that you can stay at home. There is nothing you're coming to do in the banking now, right? And they also want to activate for you online banking so that you can pay your employees from home. You just process everything and authorize and let transaction happen. Now we also have deposit taking machines where you can go and deposit your cash and everything is processed. So basically, with that kind of technology, you have to restructure yourself and say that the wastage properties, if that room is not being used, you can actually stop paying rent on it or just let it go. You reduce, you restructure or reorganize, right? So that is how it happens. Technology can cause such kind of things. The next one, we have business direction. Business direction. So Florence, next semester I'll be Most likely next semester I'll be teaching triple A. Though I didn't want, but I'll be teaching triple A. Our teacher, Mr. Manena, has been transferred to Kisumu. He has been moved to Kisumu. Florence, you can give him a call, say hi to him. So yes, so he'll not be around from next semester. I'm feeling so bad. I'm so sad, but that is it. He was a good lecturer. He's one of the best lecturers that we have, but so sad. Yeah, don't worry about revision. Classes will run. He will continue before he leaves, and I'll also come in to assist. So don't worry about revision. So Florence, are you happy that I'm in that unit, really? Okay, so let's proceed. So business direction. You are happy, but me nakuanga mkali. Yeah? Nakuanga mkali sana. The next one, I've talked about business direction. So we're saying that if one business is one thing is if one thing is not very certain, then things might change. You know, one thing that keeps on changing is change itself. Ukiona vile watu wanafanya biashara ina change, you need also to change like that. That is where the business is. I don't know the kind of example that I can give because one thing that keeps on changing is the change itself. Right? It is one thing that will it is constantly changing. It is constantly changing. The word change keeps on changing. So you need to come up with new ways of doing things. Like we used to have people going to the banking hall, but now we have mobile banking. You know, some clients were very skeptical. They didn't want to allow people open account at home. You know, kuna banks, they couldn't allow people to open bank account online. They want you to go to the banking hall. Siku hizi, most banks allow you. I remember the first time I went to open bank account, I won't mention which bank. The minimum to deposit was 5,000. And that 5,000 was non-withdrawable. Hiyo ni minimum deposit. You unaweza fungua na account na you are not supposed to withdraw it. And then equity came. When equity came, it changed the direction of business. It became more friendly, more innovative. And so things change the way business happens, right? And that's why we're saying that the direction. You now accept people with slow pay slip. You can accept Mama Mboga, Jua Kali people. You accept everybody, the business direction. So that kind of things might make you change the business model and even the structure. Florence asema nini hapa? Okay. The next part is performance gap. Performance gap. Performance gap. If there is no good performance, if the company is not achieving its goals or objectives, they are not doing well, then you might ask yourself, what is not happening? So if your organization goals and objectives are not being met, changes are required to close the gap between the expectation and the actual performance. So that kind of change might lead to reorganization, where you can now reduce the amount of work that somebody is doing, or try to look at change the ways they are doing the business. So you need to identify the cause of the gap, then you find the steps that you need to take to address the problem. We also have external pressure. External pressure, maybe the regulators, maybe the government, maybe the auditors, they're telling you this is the direction to go. Those kind of things can also change the way you do business. External pressure can change or make you reorganize yourself. You guys remember when we were having COVID-19, most buses had to change their sitting arrangements. Yeah. So unapata kama it was maybe a 33-seater, it can only now carry maybe 20 something, right? They had to space the seats. That is restructuring, right? Most buses were told now they cannot go to Ushago, they cannot carry people, but they can carry food. So you find buses like EasyCode now, they had to restructure themselves and now use most of their buses as cargo. They will use them to carry goods. Chakula wanatoa hizi vitu, wanabeba unga, wanabeba vitu, right? That is what used to happen. So what we are basically saying is that the pressure from the government or whatever source can also make you change. Let's look at the types of reorganization. Types of reorganization, corporate reorganization. Types of corporate reorganization. Types of corporate reorganization. So the first one is called mergers and consolidation. Mergers and consolidation. So this is where the company can be acquired by another one or consolidated for some reasons. They have accumulation of assets together where two corporate companies can accumulate their assets and report as one entity. We have another one called corporate buyouts. I want you to listen very carefully. This is an area that examiner likes setting. I don't know whether it came in the last setting. Let me check. They normally confuse students na hii area. Wacha niangalie last setting what you are having. Bwana inakataa hazikuji. What was that past paper? Nani ako na past papers? Nani ako na past papers? Past paper questions. So like in in December 2022, you can write down the question. The year December 2022, question number 4, A and B. December 2022, question number 4 and A and B. That was from this area. They were asking that explain 4 stages that a company might go through during restructuring. What are some of the things that can happen in the company during restructuring? August 2022, question number 4, A and B as well. August 2022, question number 4 and A and B. They were asking, assess 4 circumstances, assess 4 circumstances under which a company will consider reorganization or will consider reorganizing itself rather than liquidating. Circumstances where the company might reorganize itself instead of liquidating. That is August 2022, question number 4, A and B. Question B was asking, in relation to corporate restructuring and reorganization. Question B, in relation to corporate restructuring and reorganization, discuss the potential advantages of a company undertaking divestment of one of its division by means of a sale of, demerger, divestment. Umesikia hizo terms, divestment, sale of, demerger. In December 2021, question number 3, A and B. So B is the most interesting one. They were asking, distinguish between the following terms: demerger and spin-off, management buyout and management buy-in, management buyout and management buy-in, unbundling and capital reorganization. So we move like that until November 2019. November 2019, question number 1. November 2019, question number 1. November 2019, question number 1. May 2017, question number 2. May 2017, question number 2. November 2016, question number 4. November 2016, question number 4. November 2016, question number 4. May 2015, question number 1. May 2015, question number 1. May 2015, question number 1. And like that. So those are some of the areas where they have set the same question. So we are looking at these terms. These are very important terms that you'll find in relation to corporate reorganization. The first one is mergers and consolidation. You have the notes I've shared already. Corporate buyouts, where you're buying a corporate, you're buying the company. Corporate buyout. So corporate buyouts are a form of corporate organization where an entity acquires a controlling interest in another company. They acquire controlling interest in another company. Like now, there is a bank that is taking over. Is it Access Bank? Access Bank is taking over National Bank from KCB. They are buying the major shares or stake. So the buyer might acquire more than 50%. We have corporate takeovers. Corporate takeovers. These occur when a company attempts to assume a controlling interest in another company by acquiring majority stake in the company. They want to take over, like now what KCB has been doing to National Bank. They have the majority stake, and so they can even make the decision. They acquire it. Usually, takeovers involves a large company acquiring a small company. From the word taking over. the management and everything. Small company taking or acquiring. It happened recently where Inspire Bank, Equity Bank took Inspire Bank. Equity Bank took over Inspire Bank. Equity Bank took over Inspire Bank. Equity Bank took over Inspire Bank. So that was takeover. When a company is struggling, they have financial challenges, you can come and take over. You're not basically buying the shares and letting remain as operational. You are coming there to take over and operate it. We have the next term called recapitalization. Corporate recapitalization. You know what capital is, right? Already you know what capital is. So we are saying that a company can be capitalized. Kuweka pesa kwa kampuni. But then the source of capital can be changed. So as process of changing the source of capital or capital structure is what we call recapitalization. So we are saying that it's a transaction or a form of corporate reorganization where a company attempts to stabilize its capital structure by exchanging one form of financing to another. If the form of financing was ordinary shares, you are now changing it to debts. If that can make you stable, or you change it from debt to ordinary shares, if that can make you stable, that is what we call capitalization. You can use stocks instead of and replace it with debt, such kind of things. Now, the next part is called divestment. Divestment is opposite of investment. Investment is about putting money or resources into a business. But when you're now reducing or taking away, it's called divestment. So let's look at divestments. That is number 5. And that is what was being asked in this setting. That was August 2022, question 4A and B. And question B was asking, in relation to corporate restructuring and reorganization, discuss the potential advantages of a company undertaking the divestment of one of its divisions. They are doing divestment on one of its divisions. So you might find that a company has got different branches or sub-companies, but they want to reduce their investment in that company. Reducing the investment, the process of giving away or reducing the investment is what we call divestment. I want to say that divestment refers to a company's strategic decision. It is a company's strategic decision. It is a company's strategic decision to sell. It is a company's strategic decision to sell. It is a company's strategic decision to sell, liquidate, to sell, liquidate, or dispose a portion of its assets. So you can see, when you invest, you are buying assets, but when you are now divesting or divesting, you take away, you dispose or liquidate, or you sell part of the assets, part of the subsidiaries, or part of the business units. So normally this one is done to streamline the operation, to make things be straight and focus on the core areas for financial improvements, or make profits. So what are the nature or what are the types of divestment? What are the ways in which company can let go its subsidiaries? The ways or methods they can do divestment. The first one is called divestiture. And you have the notes, it's called divestiture. Divestiture. This involves outright or direct sale or disposal of a company's asset. Ni kuuza directly. Unauza bila kuogopa. It's called divestiture. The segment can be sold to become independent, and the company and the parent company will no longer has control on it. Let's think about this. We have Safaricom M-Pesa Foundation. So let's assume that at some point they were together. Safaricom M-Pesa Foundation was part of the Safaricom. Then they decide now to let it operate itself. I don't know, it's around Thika. So it is going to operate on itself. Then that is now divestiture, because it has given out that fund to maybe NGOs or whoever, they are going to operate it separately. So they don't have control on it at all. That is called divestiture. Then the next one we have, so we are saying that divestiture involves selling off a business unit of a company to another company. We are together. It involves selling business units of one company to another company, or an asset or a subsidiary to another company, right? So these divestitures are normally used so that the company can focus on their main business. They can focus on the core business, which can give them the best revenue. This divestment or divestiture can be classified into different categories. The classification can also be classified there. You can also call them divestment or divestiture. What I'm saying, ukiulizwa the types of divestment, you can still state them. Ukiulizwa types of divestiture or forms of divestiture, you can still state them. So let's look at these ones. What are they? The first one is called spin-off. So we're talking about forms of divestiture. Forms of divestiture or divestment. Number one is called sell-off. So that is the one that they sell directly, a department. Then we have the next one is called split off. Split off. We have split ups. We have spin off. We have spin off. So we have spin off, split off, split ups, etc. Sell off. There are quite many terms. There are quite many terms. We also have another one called carve out. We also have carve out. All these can be said to be form of unbundling. I want you to understand something. The term unbundling, to bundle, is to put together something like that, bundles. Unbundle equal achilia. So unbundling is a way in which company can let its assets go. The same as divestiture or divestment. The examiner can ask you, what are the forms of unbundling? Unasema ni hizi. Unbundling, unasema ni hizi. It is a way in which the company disposes of its assets. It is also the same as the divestiture or divestment. These ones. So the examiner can use the word unbundling. You simply say it is a where or it involves disposal of assets, facilities, production lines, or subsidiaries. They dispose of facilities, production line, assets, or subsidiaries. These are the forms of unbundling, and they are the same forms of divestiture or divestment. So now, I've given you a few. We also have the merger. We also have the merger. Let me see if there is anything that I'm leaving out that you need to know. So I want you to write a few things under this. Nataka uandike vitu zingine hapo under this. Start with divestiture. And say that it is the opposite of investment. It is the opposite of investment. It means disposing of an investment or ownership. It means disposing of an investment or ownership. It means disposing of investment or ownership of certain assets, ownership of certain assets, production line, business units, or workforce. It is done to release funds. It's normally done to release funds for more effective use. It is done to release funds for more effective use. It is done to release funds for more effective use. It is done to release funds for more effective use. Is done to release funds for more effective use. It can also be done so as to concentrate on core activities. It can also be done so as to concentrate on core activities. The next one after that, you go to spin off. Spin off, define spin off. Spin-off, to say it involves creation of one or more new, which statement? Divestment or divestiture. I said that it means disposing of investment or ownership of certain assets, production line, business units, or workforce. It is done to release funds. It is done to release funds. It is done to release funds. It is done to release funds that can be used more effectively that can be used more effectively. In other areas, it can also be done so as to concentrate on core activities. It can also be done so as to concentrate on core activities. It can also be done to concentrate on core activities. Let's look at spin-off. Spin-off. The other one I said it is done to release funds that can be used more effectively. Number two, I say that it can also be done so as to concentrate on core activities. So as to concentrate on core activities. So the next one is now is spin-off. We are saying that it involves creation of one or more, 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 new fully independent companies from the existing company, creation of one or more, 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 new independent companies, new fully independent companies from the existing company without transferring ownership to outsiders. So spin-off is like you have a big company, but then you take part of it, inakuja ina form a full company. You guys remember in Form 1, the formation of the earth. Lawrence, do you remember the theories, the formation of the earth? We are saying that creation of one or more, it involves creation of one or more new, fully independent companies from the existing company, fully independent companies from the existing company, without transferring ownership to outsiders, without transferring ownership to outsiders, without transferring ownership to outsiders. So I'm saying that if you remember the formation of the theory, and this formation of the earth, according to those theories, the first theory we used to have is called nebula cloud theory. Nebula cloud theory. The next one was passing star theory. Yes, evolution theory. Umekumbuka? Now, formation of the earth. They were saying that a star with a greater gravitational force than that of the sun passes closer, or no, the other one was the passing star, the nebula cloud. It passes close And then it rotates. As it rotates, the particles split off. And then they spine and form different planets. So it's like that. A bigger company split, that part become a fully formed planet. So we have so many companies. Spine. They move away, but they go and form a company. So that we have this one independent company, but the ownership is still retained by the same guys who owned the first one are still owners of these other ones without transferring the ownership. Without transferring the ownership. Florence, those were more than 10 years behind, and I still remember the passing star theory and nebula cloud theory. So that is what we are looking at. So you have written the spin-off. Write for me sell off and say it is a form of divestment where a subsidiary is sold to a third party. In this one, the ownership is retained. In sell off, imeuzwa from the word sell. It is where form of divestment where so we talked about spin-off. We are now on sell off. It is a form of divestment where subsidiary firm is sold to a third party. Subsidiary firm is sold to a third party. And of course, we say that spin-off is where an existing firm is split into two or more. An existing firm is split into two or more. Then they go and form a new independent or autonomous company without interfering with the parent company, and it has its own. It has the same directors without transferring directorship. So it does not depend on the first one. It is independent or autonomous, and you don't transfer the ownership. In sell-off, you give it to a third party, so the ownership has been transferred. I want to write the next one. Define for me the term unbundling. Define for me the term unbundling. And you say, it is a strategy of portfolio reconstruction. It is a strategy of portfolio reconstruction and unbundling. Unbundling. You know the types of unbundling, fine, but just define it. It is a strategy of portfolio reconstruction where the assets, business units, production lines. It is a form of portfolio reconstruction where the assets, business units, production lines, operational divisions or operating divisions of a company, production lines, operational divisions of a company are disposed or separated from the parent. Are disposed or separated from the parent. Are disposed or separated from the parent. Which one have we not defined? I want to define carve out and say that carve out is similar to spin off or spin off. Spin off. This one. Carve out is similar to spin off. Carve out is very similar to spin off, where a new company is created. Only that the new independent company form a segment of the parent company. It becomes part of the parent company. It is independent company, but it is a segment of the parent company. Unlike this one, which was autonomous, this one is a segment of independent company of the parent company. And its shares and the shares of the new company, are sold to the public through IPO. The shares of the public company are sold to the public through IPO. Which one again that we have not? Split off. Remember, spin off, we said that you remain with the ownership. In split off, you say it is where the parent company creates a new subsidiary. It is where a parent company creates a new subsidiaries and offers shares in the new subsidiary to shareholders. And offers shares in the new subsidiary to shareholders. But they have to choose between the subsidiary and the parent company. Sijui kama tunaelewa. It is not being given to the outsiders. So first confirm that you have written it well. It is where a parent company creates a new subsidiary. Parent company creates a new subsidiary and offers shares in the new subsidiary to shareholders. And offers shares in the new subsidiary to the shareholders. Offers shares in the new subsidiary to the shareholders. But they have to choose between the subsidiary and the parent company. They have to choose between the subsidiary and the parent company. So what we are talking about in split off, you need to differentiate between this and spin off. In spin off, we have a big company, we split it and make it independent. The ownership remains. In carve out, we form a different company, but it becomes a segment. It becomes a segment of the parent. In split off, the same thing. We split the company, form a new company. When you form a new company from the old one, unlike spin off where the shareholders do not change, in this one, the owners of the parent company issue shares to those who have come here. then tell them whether they choose. They can either buy shares huku ama huku. Wacha nikuelezee vizuri. Ni kama for example, nchi imegawanywa. Kenya, divide Kenya into two. So if you divide Kenya into two, then what will happen? When you watabaki hiyo side nyingine, unawaambia you can decide to come back home to the parent company ama mbaki huko. You have new shares there. So when we separate this company, kuna shareholders wamekuja hapa. We now issue new shares on this new company, and those shareholders whose shares are here, they are being told that they can either decide to come back here, the parent company, or remain here. So new shares are issued here. We are changing the ownership so that we can have this one a separate company with capitalization or capital of maybe 10 million. We issue new shares. And because the shareholders of the parent company have got interest here, we now give them option. Buy shares here, or you can as well come back and stop owning this. Unaachana na hii, kuja ununue shares zingine hapa, ama you buy these ones. It is different from spin-off. Spin-off, they don't have alternative. The ownership remains, nothing changes. There is no new shares that are issued. In this one, they issue new shares back to the same owners who are there, and then tell them to make a choice whether to move or not. That is split off. In carve out, it remains a segment. It remains a segment of the parent. Examiner attack confused na hizo vitu ndogo ndogo, but don't worry, you shall overcome. So I want to say, I don't know if there is one that is still remaining. We have the merger. You can say the merger, define the merger, opposite of merging. You can say that the merger is the splitting up of a corporate body. The merger is the splitting up The merger is the splitting up of a corporate body into two or more separate independent bodies. It is not a sale of these bodies. It is not a sale. It is about separating or splitting up a corporate into two or more separate and independent bodies. And the shareholders and the original shareholders still have shares in both. So you come and split this one into two or more. The shareholders still have shares on this. They still have shares on this. They still have shares on this. They have shares on this. So it is splitted. So you split it in two or more. It is not a sale. They are just coming to be separate entities. The shareholders of the original shareholders still have shares in both companies or all the companies. The next term that I want you to look at is called management buyout. Other terms, say that other terms in corporate reorganization. Other terms in corporate reorganization, we have management buyout. Management buyout. Management buyout, you can say it takes place if a business unit or division it takes place when the business is or division, business unit or division takes place when the business unit or division is sold to the management or managers running the same units. When the business units or divisions are sold to the managements running those units. Sasa kama wewe ni head of finance, wanauza hiyo department, wanakuuzia wewe mwenyewe. Safaricom has got M-Pesa. If they want to sell M-Pesa, that is a business unit, they sell it to the head of M-Pesa section. They have customer care department where they call it call center. Those guys can do good job to other corporates, just receiving calls, answering questions, good customer care. They can decide to sell that department. They sell it to the head of that department. That is called management buyout. Wanakuuzia wewe mwenyewe, the manager. That is the opposite of management buy-in. Management buy-in, they sell the unit to other people who are outsiders. They now sell it to outsiders. You can say that management buy-in takes place. Management buy-in takes place where the manager is where the business is sold to a team of professionals outside the management, or a team of professionals outside the managers who are running the business. When the business unit is sold to a team outside the management that is running the business, sold outside the management that is running the business, is sold outside those who are running the business. Tumeelewana? So management buyout, they sold to the existing managers who are running the business. Then we have management buy-in. This one, they also call it MBO. When you grow up, utaambiwa kitu inaitwa MBA. Management by action, not masters in business administration. Management by action. So we also have management buyout, MBO. Then we have management buy-in. Hii sasa wale watu wako nje wanaingia, they come in, management buy-in. Sold to professionals, where the units are sold to professionals who are not the managers of the units, the business units. Who are not the managers of business, the existing business units. So, I think tunaendelea vizuri. What else can be said here? Nataka nimalizane na theory. Kesho tunafanya hesabu kidogo, alafu tunafunga virago. Sio? We close. So, what else can be said here? Capital reorganization. Say capital reorganization. Capital reorganization. Capital reorganization is a part of corporate structure or corporate reconstruction. Now the word reconstruction, reorganization, and restructure, they are basically the same. So it is part of corporate reconstruction in which the capital structure of the firm changes. It is like recapitalization. Capital reorganization is the same as recapitalization, where the capital structure of the company is changed. The capital structure of the company is changed. It is called capital reorganization. Capital structure of the company is changed, called capital reorganization. Let's look at the causes of business failure. Causes of business failure. They are also the same as factors that are responsible for financial distress. Wakati sasa unasumbuka hivi, unajaribu kustructure, unajaribu kusplit, unajaribu kudemerge, do all that. Shida imetokea wapi? What has caused the problem? So look at the causes of business failure. Not symbols. The ones that we have looked at were symbols or symptoms. We are now looking at causes. Causes of business failure. Causes of business failure. Number one, poor accounting practices. Poor accounting practices. Poor accounting practices. So we are talking about poor accounting practices. What can make the business fail if you have fake accountant anafanya vituko? You know, I told you guys that some of the things that we see when we are auditing are different from the things that we're teaching in class. Unaambia mtu anajua vizuri that this is how things should be done. Eh? When I was teaching you, for example, sorry for unrealistic budgeting and pricing. Unrealistic budgeting and pricing. Florence, maliza CPA uanze kazi account, you'll be rich. Those people, they have money floating everywhere. And remember, accountants cannot be audited by the internal auditors. Yeah, kama yeye ni accountant, internal auditor mwenye kwa hiyo kampuni hawezi audit. Anajifanya yeye ni mkubwa, is a deputy CEO. So huwezi enda umuulize ati nini na nini. Kwanza hiyo room is a no-go zone, out of bounds. Ofisi ya accounts, out of bounds. Au ma internal auditors wanaenda tu kwa procedures, customer care, they look at the operation, how you do operations, nani anakuja late. Kwa finance department hakuna kukanyaga. Sisi ndio tukiingia wanatetemeka. Unrealistic budgeting and pricing. The next one, cash flow problems. Cash flow problems. Ni ukweli, hao watu wanakula na CEO vibaya. Na siri wanajua tu. Unrealistic cash budgeting and pricing. The next one is cash flow problems. Cash flow problems. Poor debt management. That is the next one. Poor debt management. Poor debt management. Poor debt management. Poor debt management. Low sales. Low sales stroke high cost. Low sales and high cost. Poor financial planning. Poor financial planning. Poor financial planning. Overtrading. Overtrading. And lastly, economic recession. Economic recession. Economic recession. Economic recession. Tumemaliza today's class at exactly 10. Thank you so much. The next area we shall look at some few calculations, and God willing, all will be good. Also, you want us to look at bootstrapping. That one we didn't, you didn't write. Umeona kwa which paper, which past paper? That is another term. Which past paper was it? (2016), the one that I've given you. Bootstrapping is also called leverage buyout. This is where you buy the company using loan. Bootstrapping. Umesikia Florence. Bootstrapping is also known as leverage buyout. You acquire a company using debt. Bootstrapping buyout. The same as leverage buyout. Buying a company using loan. Buy a company using loan. That is bootstrapping or leverage buyout. So tomorrow we shall start on ways of predicting corporate failures. Ways or models. Models of predicting corporate failures. Models of predicting corporate failures. You made a paper asking for pre-merger. So what is wrong with the pre-merger? Before merger, what is wrong with it? Are they looking for the earning per share before that? Are they looking for work before merger? What are they asking? Pre-merger. Now you know post-merger. EPS pre-merger, just calculate before merger. You go to each company, calculate their EPS, that is earning, total earnings all over, number of shares before they are merged. Hapo si ni rahisi. That is pre-merger ni before merger. Post-merger is after. Sio ni rahisi sana. Probably they wanted to compare what was the EPS before and now after merger, what is the EPS? I don't know what the intention would be. Probably.